Warm welcome to everyone who's gathered over here. I'm Sani from Imarticus Learning, and before we start up with the webinar, I would like to give you a brief about whom I represent and what we are here for with this webinar. Before that, I would like to do a quick checkup. Can you guys hear me? If you can hear me, please, can you put on the questions panel? Yes, no? That would be great. Thank you guys for that. Okay, so before we have our webinar and on trade, I would like to give you a brief introduction about Imarticus. So we at Imarticus provide industry-related training to meet the skill set of the leading companies nowadays who do train for sectors like financial services, business analytics, and leadership development. In short, we do trainings in finance, business analytics, as well as in leadership. And the segments that we do training is B2B as well as B2C, which is something that I would not like to go on with. Our offerings are, we do courses that are knowledge programs that are 2 to 3, 3 months skill upgrade programs, which we like to call it as pro degrees, as well as we do certification programs, which can go up for about 7 to 30 days of training programs for which we certify you guys, as well as we have our job training oriented trainings, which is again a pro degree kind of course, which gives you a 3 or 4 month program with placement guarantee, as well as corporate trainings, wherein we have our corporate alignments and we give you workshops as well as programs on this. As well as we also do college programs, which is a 2 to 3 month programs that we do. And these training programs is something that we deliver to you via classroom training as well as online training, and with the help of blended training also. So this is what we as Imarticus represent, is what we do. So now that you have a brief knowledge about what we do, I would like to now give you a brief knowledge about who the trainer is for today. And just a minute. So the trainer that we have today for our webinar is who has done BSc Biotechnology from Bangalore University 2005. He has completed his MSc from De Montfort University, UK, and has done from 2008 to 2011 trade European and American fixed income bonds with proprietary trading firm. And about 2011 to 15, he has done managed proprietary trading business with OSTC, and from about to 2017, he has managed proprietary trading funds with Edelweiss. So in all, he has about a lot of experience that if I want to quantify it, 9 years of experience in trading multiple asset classes on leading futures exchanges globally. And I would like to now, I would want you guys to join in welcoming Chintan sir, who would be now taking forward. So I guess you guys are pretty excited for the webinar coming forward, right? Yes or no, guys, on the questions panel? Yes. So now I would like to now give the stage to Chintan sir, who would take forward with the class. Thank you.
Hello. Good evening, everyone. My name is Chintan, and I think before we move onwards with the rest of the session, I'd like to quickly check if you all can hear me clearly. Okay, great. So first of all, thank you very much, everyone, for coming today to be a part of this, I would say, information session. As Kezia mentioned, I'll quickly brief about myself. I started as a futures trader in 2008 in the month of June. So if you all remember the dates of the global financial crisis, I think the effects of those started coming in around September of 2008. And since I entered into this space or this business in the month of June, I went live right at the, I would say, peak of the, I would say, crisis. And as you can all imagine, the journey from that point onwards until today has been extremely, I would say, satisfying and rewarding. So I've been around in the proprietary trading space with some of the leading brands in India as well as globally. And the objective of this webinar is to really spread awareness about what exactly the global financial markets are, and what has the industry done over the course of last 10 years here in India. So before we look at India, I think it's extremely important to get some kind of an overview on how this all started. So I think if you look back at 1890s, the trading actually used to take place in the pits of an exchange. So a pit, as you can see in the picture here, is a common place where all the market participants would get together. And you would have a person standing in the center, technically a broker, and he's the person responsible for, I would say, accepting orders from the people who are out in the pit. So as you can see, all the market participants, or the so-called traders, they would have to literally, I would say, raise their hands and speak out very loudly for their orders to be heard clearly by the broker. And as you can see, it's a very crowded place. So back in the days, for you to really, I would say, be profitable, you did not just need to have a good sense of the market sentiment, but you would have to be physically very strong and extremely loud at the top of your voice so that your voice gets heard by the broker, right? If you were good at both those things, then you could be, I would say, a successful and a profitable trader back in those days. Obviously, there are a lot of limitations of this model that if you wanted to trade in Chicago, you would have to be physically present in Chicago, right? If you wanted to trade in New York, you would have to go from Chicago to New York. If you wanted to trade Australia, you'd have to fly down to either Sydney, Melbourne, or other Australian countries where the exchanges would let tradings happen in the pit, right? So as the time went by, over a century ago or onwards a century, we are now at a stage where technology has helped revolutionize the way, I would say, market participants interact with each other, right? So just 1 second, guys. Okay, so I think we are back here. Sorry about that. I think there was a small technical glitch. So as you can see on your screens, markets these days are now electronic, which means you can literally be seated anywhere in the world, and you can have access to all the global markets right where you're sitting. You can pretty much be sitting in the city of Mumbai, and you can now be trading on Chicago. You can now be trading on Japan. You can be trading in the Eurozone, in the US. Right, you don't have to be at a location where the trading takes place. In terms of the I would say exchanges that exist, you have NSE, which is the National Stock Exchange of India. It's the I would say one of the most reputed exchanges in the country, followed by BSE, standing for Bombay Stock Exchange. Of these two exchanges, BSE is the oldest one, which is about 110 years old. NSE is more, I would say, a younger exchange. You then have MCX, which primarily deals in the commodities side of things. So these three, I would say, are the major exchanges in the country. If we were to look at some of the exchanges globally, you have CME Group, which is based out of Chicago, right? And CME is technically the oldest exchange in the world, and it is also one of the biggest exchanges in the world, right? Followed by that, you have Eurex, which is based out of Germany. It represents all the Eurozone traded instruments on it, including futures, options, shares. The other bigger exchanges on the list is ICE, which is based out of US. As we saw from NSE and BSE, that NSE is more younger exchange with more sophisticated technologies. Same is the case with ICE. ICE is one of the most youngest exchanges in terms of its age, right? But it has captured a very significant market share in the course of last 10 years. If we look at exchanges, the dominant exchanges in Hong Kong and China, LME is an exchange in the London, which is owned by the Hong Kong firm. And if you look at the most popular exchange in Singapore, it's the Singapore Exchange. So this kind of gives you a very high-level overview on what are the marketplaces where the global financial institutions come together to find, I would say, trading opportunities. Right now, before we move onward with the presentation, I'd like to get a very quick, I would say, overview of the kind of audience that we have in this webinar today. So I think my team member is going to run a very quick series of 3 or 4 questions, which will help me understand your background, and then I can tailor the rest of the presentation accordingly.
Hi guys, just to understand. Just to understand the audience that we have today, I have 3 to 4 polls which I would like you guys to answer. All right, so the first poll goes like this. Can you all answer to which age group do you guys belong to? If you would just click on the age group that you belong to, that would be great. We have 1 minute, yeah, 60 seconds, guys. Okay, thank you guys for that vote. We're going to continue with the next poll. So we just want to know if you have ever traded before. Yes, no? Thank you guys. And if you have traded before, if yes, then how long? We would like to know that. So if you would just guys, I've just got 50% of the word. Can you guys please? Thank you guys. This is the last poll that we have. We just want to set the expectation right. If you would just answer this, thank you. Only 67% of the audience have voted. Guys, please do vote. 78, 80, 83. Thank you guys for letting us know. We will now continue with the lecture.
Perfect. I think we have quite an interesting mix from what I saw as a feedback. Most of the people that we have on this, I would say, presentation today are between 22 and 26 and are looking to be an independent trader. To be very honest, before going further, I wasn't expecting the kind of, I would say, feedback, because my assumption told me that not many people were aware about career as a corporate trader, or we're very open to taking risk and becoming independent trader. But I think very interesting. So moving on to the kind of asset classes that are traded in India and globally. If you can see, the first of that section is the energy markets. Now, energy markets are not as popular in India, but they are extremely popular in the developed economies like US and the UK. And the most important contracts that are traded on the energy segment include your products like Brent, gas oil, heating oil, natural gas. The second most popular asset class is the interest rate segment. And again, I think as far as India is concerned, the interest rate space is pretty new. It's been existing close to 5 years. But if you look at the development on the interest rate segment in the developed economies one more time, you would see that these contracts have been trading for close to 75 to 80 years now, right? And the most popular kind of interest rate products that are traded at the prop trading firms as well as financial institutions on the listed space will include your short-term interest rates as well as the bonds that are issued by governments and the corporates. The next and the most popular asset class between the retail trader category and I would say new traders is the currencies, where they trade currency pairs like Euro USD, JPY USD, GBP, INR. So those are a few, I would say, examples of the currency products that are traded in India as well as globally. Equities, again, is a very popular asset classes. I think most of the people that start trading domestically would have their first experience trading the equities only because it's probably an asset class that our fathers and our relatives may have had some kind of an experience of. The next asset class, which is a very, I would say, wider category, is the commodities, which include your physical commodities like grains, include soft commodities like coffee, cocoa, cotton, sugar. And again, these are more popular on the American exchanges and the European exchanges than they are in India. So looking at the next slide, I think we briefly looked at the kind of exchanges that exist in the world or the kind of asset classes that are traded on all these global exchanges. It may occur to you, what are the kind of transactions that take place on these exchanges on a yearly basis. So if you see on this slide, right from 2007 to 2016, as we can see, there has been a massive growth in the number of transactions that take place across the world, right? In the year 2016, as you can see, the transactions at that exchanges, all the exchanges combined globally, have been close to 16 billion trades, right? So that's the kind of size that has been trading on these exchanges globally. And if you can see, there's a further breakdown in terms of how these volumes have grown in terms of regions. So Asia, if you see, has seen a very dramatic shift in terms of the volume contribution. Back in 2007, as you can see by the purple line, it was close to 1 billion trades that were happening, and now we are close to 6.5 billion trades, right? So I think these are very, I would say, great numbers in terms of growth or the interest that is seen from the market participants on these exchanges. And mind you guys, this is only one of the derivative product segments that we can see. As you can see, the slide says it's only the amount of futures that are traded. The next category is the options. And as we can see, options have been pretty static if you see compared to the futures market because of the kind of volatility that we have seen over the course of last 10 years. So the volatility was pretty decent to high in the years of 2007, 8, and 9. And it was at its peak around 2011 during the time of Greek crisis in the Eurozone. And of late, if you talk to us as market participants, I think the volatility is at its, I would say, all-time lows, and it's extremely difficult for the algorithms or the human beings to be consistently profitable in the options segment, at least, right? Futures traders have continued to do extremely well over the course of last 10 years. Now, in terms of the asset classes that are traded on these global exchanges. As you can see, interest rates and equity indices comprises of a very high percentage of the total volumes that trade across these exchanges, which is then followed by equities and the currencies. So the top four asset classes that remain very popular between retail traders as well as the financial institutions are these interest rates, indices, individual equities, and the currencies. And all the other asset classes like your metals, gold, silver, or Brent gas oil, or the corn, cocoa, coffee, they contribute smaller percentages compared to the other four. Similarly, if we look at the options breakup, as we can see, the top two are the equity indices, which is close to 50% or a little bit lower across all these years. But if you combine equity indices, individual equities, and interest rates, they constitute a very high percentage of the options market or the options products that trade on India as well as global exchanges. So far we have seen the financial exchanges that let market participants trade. But if we now have to look at the broader businesses that are professional players on these exchanges, they include your proprietary trading firms. By principle, proprietary trading firms are always trading their own capital, which means they are always putting their capital at risk in an effort to generate more profits on it, right? Some of the proprietary trading firms that have been existing in India, they've been existing in India for the course for nearly 10 years now, and I think we will look at some of those in the later part of this session. The second broader kind of a category that lets market participants trade on the exchanges are the trading arcades. And in terms of the way trading arcades are different than proprietary trading firms is that trading arcades let people risk their own capital. So if someone like you or I was interested in trading on the markets, instead of us trading these individually from our own locations, it will be a common setup where people would get together. People would get together and make, I would say, more collective judgments or decisions on the market, right? And because it's a group of, I would say, 40, 50 traders sitting in one location, they also get benefit from the scale that they have as a team. The next broader business category is the hedge funds. I'm sure you've all heard about this term somewhere before, but hedge funds are technically private funds that raise capital from individual investors or financial institutions. And they use that capital to trade on the markets by using both long and short trades. Now, in a way, hedge funds are different than your pension funds and mutual funds in a way that they are not generally regulated by any of the regulators. If you talk about the regulatory bodies in the US, you have your SEC. You talk about the regulatory body in the UK, it's your FSA. In India, it's the SEBI. And those regulators oversee the activity that these funds do with the kind of positions that they take with these funds. As I said, hedge funds are not regulated, but the next two category, which is your pension funds and mutual funds, where the deposits are accepted from the retail investors, those are more regulated to ensure that the capital is used or invested in a correct format, and they are not invested for more speculative purposes. The next category of firms that interact or that trade on the markets are your insurance companies. So whenever you and I, pay premiums for our insurances, we would mostly look up on a I would say a ULIP plan that kind of gives us a bit of insurance, but a lot of the capital from the insurance premium are also get invested on the financial markets. Going forward, the next category of market participants are your physical trading companies, like your Getcos, your Cargills, your Trafigura, that are responsible for transfer of physical commodities from one part of the world to the other part of the world. And they would usually trade on the exchanges to hedge their exposure in terms of their inventory. The last and one of the most interesting businesses on the investment management side is your algorithmic trading firms. And these firms would mostly have people with engineering background, having great programming skills, and a fair bit of understanding of the financial markets. They would design algorithms that will read and understand the market behavior in terms of its price, volume, open, high, low, close range, and then make decisions based on the previous activities in the market. So algorithmic trading firms will rely more on a pre-agreed set of rules that will make trading decisions instead of human beings watching the markets and making more discretionary decisions. So some of the myths about trading, I think, over the course of last 7 or 8 years, whenever I've had a chance to interact with youngsters like yourselves in the colleges, I would often ask a question in terms of what do they think about trading, and quite honestly, a lot of them have come back to me and say that they think trading is gambling, right? Which is very weird, because that's the kind of common prevailing thought process in most of people's mind. Now, having spent close to 8.5, 9 years on the trading side of the business, I can say if even crossing a road is gambling, right? If you don't take proper measures, if you're not looking to your left where the vehicles are coming from, and if you just start walking, there's a high chance that you might get crashed. And same is the case with trading. If before you put on a trading position, you're not sure about what your profit target is or what your stop loss target is, why are you putting the trade on? The underlying principle. If there's no plan around trading, then I think that kind of feedback is pretty obvious. But having, as I said, having spent so much time, I totally disagree that trading is not a gambling. It's more of, I would say, a business, right? Pretty much like your own business. The other common thought process in about trading is that whatever goes up in the market will come down. Right now, this is not always true. I think the markets are always taking one of the two forms. They are either bearish or bullish in nature, and they are driven by fundamental as well as technical factors. So as a retail trader, I've seen a lot of my friends and even my relatives, having the kind of thought process in the mind that the markets have been going up for the last year and a half, and I think it's about time that we should see a correction. But that's more like a guess, right? It's not a more thorough research. So that's a very wrong myth that people usually have about trading. Some of the people that are trading the markets, they would also a lot of the times fill out their charts with a lot of technical indicators, right? And if you are someone who uses those indicators more regularly, then obviously you also know that all these indicators are driven by the price. So price is the primary input into calculating either be it your RSI or MACD, but there is no indicator better than the price itself. A lot of the novice traders also think that higher leverage means higher profit, which is not always the case, because the leverage, as we all know, is a double-sided sword. And if you don't use it correctly, there is a high chance that you might end up eroding your capital that you've invested in the business. We're going to play a video, but I don't think you'll all be able to hear it very clearly. So I think we'll move on to the next part. I think what we will do is, after the end of this webinar, we will send you a link to that video, and I think you can have a look. So it's about a 1.5-minute video, and it shows you what is the life of a trader about. So moving on, I think a lot of the times I've also gotten asked in terms of what are the qualities of a successful trader. And in my opinion, I think it's extremely important for that person to be making their own decisions. Now, I've seen a lot of times that if you and your friends, or if me and my friend, we've been in a room together, we're watching a market, we would all come at a single decision, right? We would probably agree to each other saying, "Chalo, isko buy karte hain, isko sell karte hain." But that shouldn't always be the case, because if you don't make your own trading decisions, then you will not be able to identify the mistakes that you're making, and you will not be able to improve upon it. as a trader or as any other profession, I think you've always got to be committed to learning from your mistakes that you make in the market. And since you're dealing with the real capital, I think being disciplined is extremely important. The other things that I've experienced in the course of last 9 years is a lot of people enter this profession to make a lot of money very quickly, and I'm quite surprised that people see this profession as a get-rich-quick scheme, which is not the case, because like every other profession, even this one needs a lot of commitment, effort, and most importantly, the perseverance, because as a new trader, when you go out to trade against those giant professionals, it is not always going to be very easy because they've been in the market for a very long time. And if you are just a new player, the chances are that you will get crushed if you don't be disciplined with your approach. The other qualities that I think are of a successful trader is they're someone who are extremely humble, and they're not looking to take revenge on the markets. Again, I think, you know, these things that you learn from experience, that once you've lost one, let's say $1,000 in a trade, you shouldn't ideally put a bigger size on in the next trade. Otherwise, there's a high chance that, you know, you've chosen that size out of your loss in the previous trade, and it's not really the size that is ideal for that trade itself, right? The other important thing that is a quality of a successful trader is that they accept before entering into a trade that wins and losses are a part of the game. So they will treat the losses with as much pleasure as they would treat their winners, and they will always try to have a ratio which is ratio of wins and losses such that the wins are slightly higher than the losses, right? But there is never a trader who will always have all the trades are profitable. You know, they will not have all trades always profitable. And for you to be disciplined and I would say successful in the trading profession, having a trading plan is extremely important. As I said, you know, you shouldn't ever put on a trade and then decide, you know, if you should take the profits when the markets have gotten to 3% high, or if they've taken, or you should just stay on the trade when it's a 10% loss. So moving on, this is a very interesting and quite a personal chart to me, and this represents the growth curve of a trader. Now, as you can see, you know, I've kind of highlighted how does a trader's P&L in the market look like when they are trading for a professional firm, especially the proprietary trading firms. Usually, I would like to think that it takes about a year and a half for any new market participants to be fully profitable, and especially that journey is very I would say painful. For the first 6 months, you will usually have months that you end up in losses, so you will give your best, you will have a great plan, and then you know, probably give up on your plan as the market moves against you, right? So all of those learning tricks, as you can see, the first 3 months you don't make money, instead you lose a bit of money. In the next 6 months, in the next 3 months, you will stop losing the money. In probably the next 3 months, which is between 7, 8, and 9, you will make a little bit of profits to cover your previous costs. And from month 10 to 12 onwards is when you will see a very you know, positive slope in your growth prospects, because now that you've spent 1 full year in the markets, you understand all parameters. You now starting to get a hang of it better than you used to as a beginner. And usually from the month 24 and onwards is where you will see a performance at its peak. And if you're someone who will remain humble, if you're someone who will continue to learn from your own mistakes, I think this curve can look pretty decent for all those individuals. Excuse me. It's the same chart. We have one more line here. And I think a lot of one of the bigger reasons why a lot of people want to choose trading as a career is to get rewarded when they are profitable, right? So as you can see, the blue dotted line on this chart represents the kind of costs that are built up as you go onwards on your journey. And roughly at, I would say, an intersection of 18th and 24th month is when you will see that you have made enough P&L to cover all your previous costs. And the difference between the purple line and the blue dotted line from month 24 and onwards is your net P&L or contribution as a trader, and you are rewarded a percentage of those P&L as your performance bonuses. So, moving on, I think if you are someone who is extremely good at identifying trading opportunities and someone who likes to be in the trading business, there are a few career options that are available for you. There is proprietary trading firms that recruit graduate students from, I would say, commerce, engineering background. They train them and then let them trade on the markets live, slow and steady. The other profession that can be opted one is a self-funded trader. So if you have capital that you can afford to risk, you can open an account with a broker and start trading. The third one is a fund manager, and that's a more professional qualification or a professional suit where you are usually trading or you're usually managing funds on behalf of mutual funds or pension funds. If you understand the markets and the functioning of the markets, there is also a decent chance that you can get positions in the exchanges in India as well as globally, and you can either be a part of their sales team or a business development team or a marketing team. The knowledge on the market is not just applicable to the trading industry, but is also applicable on the investment banking side. It's probably the most front office roles that is available out out to the best of the candidates. The next category is the hedge funds. Again, as I said, hedge funds are those private pool funds that manage funds on behalf of ultra high net worth individuals. Understanding of markets also can open career opportunities for you in the domain of risk analytics or software companies. In terms of the remuneration that I think we have experienced in India in the course of last 8 to 10 years is now this is a very specific example of the proprietary trading setups where these firms will recruit individuals and train them under their own I would say training programs. So the firms there is about 15 to 20 firms that are based out of the entire India, and they usually work on a profitable model, model that where traders like yourselves can get paid bonuses once you've covered your costs. But in terms of the offerings, I think they offer salaries in the range of 2 to 8 lakhs per annum. That's the kind of broader range that we have in India. The desk fee or the infrastructure fee that they charge per month ranges in the range of $2,000 to $4,000, and this is per trader per month, where the fee goes towards providing individuals with access to the global markets or providing them with the risk capital or I would say the margin capital. So once you've made, let's say, more than $4,000 in a month, depending on how much more you've made, you can be entitled to a profit split in the range of 20 to 80%. So I think that's a pretty decent profit split that's available. And the risk capital contribution. So in terms of the trading arcades, as I said, individuals get together in a common location to trade their own funds, and there is also setups where you as an individual can risk your own capital, in which case there is flexibility in terms of how much of the risk capital you want to contribute. It could either be a 0%, it could be 100%, or it could be a number between those two. So I think with that, keeping the kind of growth that we have seen in the industry and the prospect that is available out in the market, we here at Imarticus have come out with a program that kind of enables youngsters like yourselves to get a flavor of what it is to be trading these markets or these products So I'm going to give you a very quick overview on the program that we have designed. To give you guys a very high level overview, I think the mode of training that we have on this program, it's not theoretical in nature like a lot of other courses that may be out there. This one focuses absolutely on the practical aspects of learning. So more than 80% of the course is more than 70% of the course is hands-on simulator, where you will not just learn about the trading strategies, but you will learn to execute them and then manage the risk. Right. In terms of the trainers that are on this program, include some of the leading traders from London and Chicago, and the course gives you a practical exposure to the real-time market prices on all the leading global exchanges. So in this course, I think you will have access to not just the Indian markets, but you will have access to the developed markets as well, the ones that we saw exchanges on one of our earlier slides. The trading platform that we are going to use on this one is, I would say, a very sophisticated and a cutting-edge trading platform, which is used by the most leading financial institutions in India as well as globally. If you look up on your Google, if you Google up your CTG, you will see that this is a pretty expensive software which is coming to you on this program. And the course is endorsed by MCX. So MCX is a knowledge partner with us, and they are trying to help us spread the financial literacy. In terms of the course structure, when we enroll people on this program, we assume that they will come with very limited or no knowledge on the financial markets. So the first aspect of the course is going to focus on the foundation of the financial markets, which includes your basics of the markets, exchanges, and asset classes. We focus on each asset classes in detail, where you learn about fixed income, money markets, FX, and derivatives. Then we move on to understanding what are the factors that drive these markets. So you will have economic indicators that are released by your government and non-profit organizations. And how is it that the central banks influence these markets or the prices of the asset classes? The next aspect of the program focuses on the trading platform. Again, as I said, it's a very sophisticated platform, and it takes time to learn all the functionalities that are involved in it. Moving onwards, I think you learn about short-term interest rates and the bond futures, and you learn about all the different kind of trading strategies that are applied in the market. So as a retail trader, I think the only strategy that you and I, or probably the retail market participants, can think of is either buying the price or selling the price, and they would probably not look at any other kind of combinations available. But as a professional trader, you learn about all different sorts of trading strategies. The next aspect focuses on the technical analysis of the sites, where you learn about how to read charts and how to read emotions in a price chart, followed by the aspects of discipline. As I said, position sizing and risk management is extremely important, which is covered in detail. And the last one, but not the least one, is trading competition, where all the participants in the course will compete against each other, and upon completion they will get rewarded with one of our partner firms in terms of live funding platform. Just 1 second, guys. Okay, so in terms of what you can expect to learn from this course, you will learn about the mechanics of all the different asset classes and how they trade, what are the factors that affect the price behaviors. You will learn to understand if the financial market or the asset that you are trading or the product that you are trading is either undervalued or overvalued. You will be able to apply technical indicators like RSI, MACD, volume profiles, and study all the chart patterns that occur in the market. Outside of that, as a course participant, you will be able to learn and apply a structured approach to your overall, I would say, trading behavior. In terms of the firms that have been existing in this space in India, you have a Futures First, which is Gurgaon based headquartered firm with close to 400 to 450 traders across 5 different locations in the country. You have Edelweiss that operates in this space as well. You have firms like Halftick Info Services, that's a Mumbai-based firm. You have OSTC, KIFS, Trade Capital, ARB Group, which is Canada-based and employs close to 300 traders globally. In terms of the algorithmic trading firms where you can apply this knowledge, for a professional trading career, include your firms like WorldQuant and Quad Securities. They based out of Mumbai and Delhi respectively. And broadly summarizing, I think when we show this information to people at colleges or at our institutes, they get extremely excited because the kind of awareness that we have seen about this space has been extremely limited, and our objective is to only bridge this gap or provide career opportunities to financial market aspirants, to help them start a corporate career or to become an independent trader. So with that, I would end the presentation, and I would welcome if there are any questions. Okay, so I think we have our first question. For a CFA completed candidate, can he get into front office in investment banking, and what exactly would work be in front office? All right, that's a very interesting question. Now, to answer this, I'd like to say that people who complete CFA are aiming to get into front office. There's 2 broader kind of categories that are available. So you can either work with a trading firm or a fund management business, and you can either be a fund manager or I would say a proprietary trader. So that's more on the listed side of things. There is unfortunately not a great deal of trading or the front office roles that are available on the OTC side in India. But those kind of career opportunities are more available in the developed economies like US and the Eurozone. So I hope that kind of gives you an overview on your question. The next question is, are the pro degree courses available in Gurgaon Center? I think someone from our operations team will pick it up and come back to you. Is the class online mode or classroom mode? At this moment, we are offering it online just to ensure that people from all over the country are able to take advantage of this. But I think there is also a plan that we will come out with classroom training in the course of next 6 to 8 weeks. Next question is there any chance for engineers in this field? Now, if you remember, I did mention that there are algorithmic trading firms that employ, I would say, smart engineers, and so engineers with programming capability in languages like C, C++, or R, or Python, with a bit of understanding of the financial markets and the behavior of the asset prices. I think there's great deal of opportunities that can be explored with systematic trading firms. Can you suggest some books that a beginner must read related to the stock markets? We actually have a list of books that we recommend all the new market participants to look at. So I don't have that list ready, but I think we can definitely have that list sent over to all of you. The next question that we have here is, what is the difference between trading arcades and mutual fund? The first and the, I would say, primary difference between these two kind of businesses is that trading arcades are more individually owned. So, you know, a group of people can own a trading arcade and create a platform where all the professional traders can come and access the market, risking their own capital or risking the capital of the firm and the trader in some proportion. So that's broadly the structure of a trading arcade. A mutual fund, on the other side, is a more, I would say, a structured investment scheme, which is offered by the fund management companies like your, you know, ICICI Prudential, BlackRock, and those kind of firms. And the investment is open to retail as well as institutional investors, whereas in the case of trading arcades, the fund that is deployed in the trading mostly belongs to the owners of the firm or the person who is trading trading the markets. We have another question which says, do you think person with experience in stock markets should directly invest in the markets or mutual funds is better? So that's more like a TV interview question. But I think I can tell you, if you are a beginner, you know, investing or trading yourself is always the best idea, because I am of the opinion that you should never pay a fee for what you can do yourself. So I would never pay a fee to the fund manager of a mutual fund. So my personal preference is always to you know, invest or trade using my own ideas and techniques. If you are someone who is already occupied, if you're a working professional in the IT industry, and you know, you have savings that you would like to invest in the markets, but you don't have time, then you can use you know, mutual fund services. But if you're someone who is capable and you have skills to identify market trends or trading opportunities, then I think it's always better to invest yourself. The next question is, after this course, can we try for financial research analyst in an MNC? I am an MBA finance with 10 years of financial marketing experience. So this is very interesting. You know, I've often come across a lot of people like this individual on our session today, and so I think having a marketing experience kind of gives you a broad flavor of the kind of products that are available either to retail or the individual investors, but you personally may not have necessarily traded these in a professional capacity. So absolutely, I think, you know, after this course, if you are someone who is able to identify market trends, or you're able to analyze the securities in a more fundamental or technical nature, it opens up a great deal of prospects for you in financial research, you know, space. The next question we have is, which brokerage firm is better to open an account, a discount brokerage firm or a branded one? Again, I think this is a very subjective question. The response to this one will be, you know, it depends on your risk capital. If you're someone who's only, let's say, prepared to risk 5,000 rupees to open a firm, and you don't trade very aggressively, or you don't trade multiple times during a day, then it doesn't really matter, you know, who you open your account with. But if your trading frequency is medium to higher, which means you trade more than 15 to 30 times a day, then I think your brokerage will eventually affect the P&L that you make. For which I would recommend you can open an account with a discount brokerage firm. But otherwise, if your trading capital size is extremely, you know, significantly bigger, and you are not comfortable risking it, then you know, it's always preferable to go with a branded and a known name. I have a 3 years. So next question here is from someone that we have. I have a 3 years experience in F&O. If I do this course, will I be considered as a fresher? Not really. I think you know, if you have been in the futures and the options space, either as a dealer or as a trader, this course will technically help you understand the concepts of domestic as well as global markets better, and it will put you in a position where you will be able to trade for yourself or for the firm that you work with, right? So I think this is going to only add value to your existing career that you have so far. When are the classes going to start in Hyderabad? I think you know, if you probably you know, wait for this session or Q&A to finish, there is going to be a small poll where all of these questions will be answered. The next question that we have is, what role does a portfolio manager play in trading? Okay, so a portfolio manager in trading, well, there's no direct association of those two, but a portfolio manager technically is responsible for investing the funds on behalf of the firm that he or she is employed with, and the firm manages funds for retail market participants as well as individual investors. Now, portfolio managers mostly, depending on what kind of firm he or she is working with, will have broader investment objectives. And if the portfolio manager is working for a hedge fund, then you know, trading knowledge is extremely essential, because the fund has to be deployed in a position where it can generate alpha over what the market already generates. Otherwise, if that person is working with mutual fund or a pension fund, then they have to design a more long-term investment strategy, and also at the same time have enough risk management processes in place by using derivatives such that the value of the portfolio is not eroded, right? So, I think having knowledge of trading, a portfolio manager is in a better position to manage the fund either for hedge funds or for the mutual funds. So we have next question. I wanted to learn all the basics trading from A to Z. What should I do? Read books or trade and get started? It's a very interesting and an important question. I think so. If I can give you another analogy, if I wanted to learn a guitar, right, what should I do? Should I be reading books or should I be playing the guitar? So I would say both is great, because you can learn the basics in the books. But for you to actually play a guitar, you would have to take the guitar in your hand and then, you know, run your fingers on the strings. Same is the case with trading. I personally don't think you can learn to trade by just reading, you know, numerous books, because you will not then understand your own psychology or your own thought process when you have positions in the market. So a lot of the times, you know, when we ran the business, we experienced that with the unreal money, a trader or an individual can take you know, enough risk and stay very comfortable with either a long position or a short position, you know, making money or losing money. But when it's the real money at play, your entire thought processes change. You know, you probably get more, I would say, excited with your profits, or you would get very depressed or nervous with your losses, and that's all a part of the trading journey. And I think during the early stage of a professional trader, or during the earlier career phase of a professional trader, this is an important technique to learn in terms of, you know, how to manage your own emotions. The next question we have is, can the candlesticks chart be considered the best among all the charts for analysis? I think it's more personal to an individual than a common thing that's applicable to the entire, I would say, trading community, because it depends on your own preferences, your own investing and I would say risk margins, because if you are someone who is willing to trade, who wants to trade more on a short-term basis, then I think market price action is best covered on the charts. Candlestick charts or the bar charts are equally good. They give the same piece of information. It's just that candlestick charts are a bit more colorful than bar charts, which is more black and white. But broadly, I would say it's more trader specific than something that can be applied in general. But I think great question. Thank you so much. So we have just touched 7 o'clock, and I think it's been. I'll take last question. Do financial analysis course will be added advantage to enhance the career? I am not too sure what a financial analysis course is, because it's a very generic term. So if you have that specific question, I think we will display our email address straight after this webinar, and you can write us that query, and someone from our counseling team will get in touch with you to answer that and discuss that with you in person. But I think with that, I think it's been a great session. It's great to have so many of you coming to attend this presentation, and we will now follow this up with a next session, which is scheduled on Thursday at 6 o'clock, where what we will do is we will go through some of the, I would say, highlights of the professional strategies that are traded by hedge funds and the prop firms, and we will be trading live on the markets, right? On the interest rates and the fixed income side on CME, as well as probably ULEX as well. But I think that's up for all of you as well. So straight after this webinar, or probably at some point tomorrow, you will all receive an email from us asking you to visit a website, download a trial version of a software, so that when we meet next time on Thursday, we will all be trading the markets together and get a really feel for it in terms of how it is to be trading these markets professionally, and how your emotions fluctuate with the fluctuations in the market prices. So with that, once again, thank you very much. I think it's been a great experience and a great pleasure to be talking to all of you. We will give you our email addresses and contact details in case you want to contact us for any questions or anything else that you have to speak to us. But thank you very much, and over to my colleague Kezia.
Thank you, sir. Guys, I hope that you had a very good session, and if you had, please answer us via this polls. So if you would just answer it quickly, we have one more poll to go, wherein if we want to know if you would like someone from our Imarticus team to come in touch with us. Also, guys, note that we have one more session to go on Thursday, and please do come in and join in for the live trading session. Thank you guys for those polls, and I guess we're going to take a leave for the day, and we'll see you guys on Thursday. Please do join us, and thank you.